A very warm welcome on a Friday evening. Let me begin this webinar with a question. If I ask you all about rule-based trading, how many of you are aware of this topic? Let's see a show of hands. Give me a Y in the comment box if you know rule-based trading. Okay, we're seeing quite a few yeses and nos as well. Okay, even if you're aware of the topic, how confident are you regarding its usage? So everyone, my name is Vignesh. I'm the influencer marketing expert at FYERS, and I am the host of today's webinar. Our company focuses on empowering new age traders to deliver the best of trading experience through its amazing tech-enabled platforms and app. To prepare you for today's webinar, let me introduce the topic. Using rule-based trading systems can allow you to take advantage of opportunities that would otherwise be out of your reach as a regular trader. With tech-driven, rule-based trading, you can employ a variety of trading strategies. To help you understand the most common strategies, we have Vivek Gadodia as today's presenter, a former co-founder of Algo Convention and Nifty Consulting. He is the CEO of RBT Algo Systems. Hello, Vivekji. Thank you so much for joining us today.
Hi, Vigneshji. Good to be here and good to see you.
Nice to see you too, sir. So viewers, this webinar's recording will be available to view on the FYERS YouTube page. If you have any questions during the presentation, type your questions in the Zoom chat box or in the YouTube comment section. We will pick up your questions as we go along and try and answer as many questions as possible. So without further ado, let's get started. Over to you, Vivek, sir.
Thank you. So, okay. Hope you can see the full screen. Yeah, the presentation. Or I have to share my screen. Yeah, can you
see the screen?
Great, fantastic. So it's a pretty interesting time to even talk about this because coincidentally, always when I talk, there is some kind of expected or unexpected volatility that happens. And we are seeing the crash in the market last couple of days. So it's an interesting time also to talk about it. So what we are going to discuss is some strategies which can be used across market types. And we will see how to create these strategies in a platform where we don't need to know coding. So we'll create the strategies in a no-code platform. We'll backtest, we'll see the results. And we'll then combine these strategies into a basket of strategies. So to create like a portfolio strategy, just how we create a portfolio of stocks, right? So I'm excited to start talking about this and sharing some data. For that, what you must have all seen that many of you who are trading that the market is a complex place. So there is so much of news all the time. There is a friend's advice or a neighbor's advice, which is both wanted and a lot of unwanted advice also. And then you have all sorts of data like institutional data is there. Then you have derivatives data like open interest and all, which some of you must be using. Then you have technical inputs and some fundamental data, what the economy is doing, what the GDP is doing and all that, right? And nowadays there's a lot of alternative data also, like, there is maybe a satellite, which is, has a camera scanning the gate of a factory and it can count how many vehicles are coming in and out. So with that, it can estimate that the sales number, which is being reported by the companies, is that correlated or is it like a fake number or is there some truth? Like if you're showing like X number of sales, sorry, at least X number of trucks should come in and out, right? So lots of various possibilities of different kind of data is there. And why I think we generally have, I've struggled over the years, and you would have seen the recent SEBI report, which is shared by, in lots of social media, I'm sure, it's picked everyone's eye, that 89% of people in the F&O, in the retail, have lost money in the last financial year, right? 89%. And why most of us fail, right, in that? Because we think because it's such a complex place, let's try to give some very complex solution with we make a chart with a lot of indicators, right? And sometimes even the price is hidden. There's so many indicators. And I tried that for a while and basically didn't work. So eventually I realized the solution, at least some way to, not fail, right? And is to make simple strategies, make simple solutions. And in any kind of simple strategies, I'm going to have phases of trades which are going to lose. So the biggest problem was wanting to get every trade right and make money on all trades. And the best traders will tell you, I read quite a lot of books and spoke to a lot of traders and learned that this is not possible, because what the market is going to do, no one knows for sure. Right? You can only estimate, and if market changes its mind and does something else, like last 2 days, right? Suddenly, something totally big trend changes happened. And you have to go along with the market. So there will be phases where losing trades will come. So accepting that is part of the game before you even want to try to win the game. So first of all, what is very important is that there are going to be losses, there are going to be profits. That is part of the game. Now, how we can, kind of still be profitable is to aim to make more money when we win than what we lose when we lose. And that's what we'll see in the backtesting. In styles of trading, which some of you do, there will be broadly 2 styles. Right? So one is a directional trading, where the trader says basically no price is too high to buy. So, and no price is too low to sell short. So example, take Adani's stock, live example on, it's been falling from about 3,600 to say 3,300 on Tuesday. And then it's fallen 3-4% on Tuesday. And then one may say, it's fallen so much now, how much more can it fall, right? So, but a short signal system which went short would have said, so whatever is the signal, you get a short trade, you sell. Right? So no price is too low to sell for a seller, and no price is too high. So in a directional trading, we are just following the price, expecting it will go away. Non-directional trading is the sort of opposite mindset. So when a breakout happens, let's say the price made a new high, a trend following trader or directional trader would buy, but a non-directional trader at that same point will sell. Why? Because he or she is expecting that the price will revert back to where it was, its mean. So a non-directional trader is always on the opposite side of a directional trader, mostly as a mindset. So if price has gone to up, he or she will sell, expect it to come down, or if price has gone to down, he'll expect it to bounce back. Like today, maybe some traders who are non-directional would have bought the Adani or would have bought Nifty Bank expecting that maybe it will revert on Monday, Tuesday. So at all points of time, there are both types of people, and at every point you will have somebody who's a buyer and somebody who's a seller. That's why the market. Rare case where only buyers or only sellers. Like today, for a while there was a lower circuit in some stocks, so there were only sellers. But most of the time, there will always be both buyers and sellers. So what we are going to do in the strategies we are going to be building, we are going to be doing strangles, right? And we will try to use both of these ideas somewhat, directional as well as non-directional, in our strategies. Okay. So a strangle definition, as most of you would know, is basically when you sell a straddle, you're selling at the money, correct? Both, not at the money necessarily, most people sell at the money, you could sell any leg, but both strikes will be same, the call and put. There's a strangle, you'll have a different call and a different put, right? It will not be the same strike. We'll see more of it as we build, but I'm sure many of you know about it already. Okay, so as we start to build a strategy, the key thing before we begin is to understand this. What is the expected value or edge for system? So I'll take an example of a roulette game, which many of you might play. So in roulette, there are 36 numbers, most of us think 1 to 36. If you bet on any number, right, and that number comes, you get paid 36 times. But there is also another number, which is 0, right? So there's a 37th number with 0. And that's in European roulette. American roulette, there are 2 zeros. So if you take that 0, what is the probability of 0 coming? 1 0. It's on say a single European roulette wheel where there's only 1 0. 1 by 37, right? One number by 37 numbers. But that is the edge of the house. Means whenever that zero comes at some point, it will come over the number of times that wheel runs. All the money kind of will mostly go to the house. The house will win, right? And it's a very small edge, but it plays out over a number of period of time. And that is why in the longer term, the casino always makes money, irrespective of some point, some player may make big or small, but over a number of times when the players play, the casino wins, or the house wins, as they say. So when we are coming in the trading, field here and, building a system and trading, it's very important for us to know what is that edge, however small it may be. But we have to first find out whether we have an edge and what is it, and only then go ahead. So something which I did not do for many years in the initial years. So I had no idea really of what I was doing. There was no consistent method. So edge or expected value is very simply calculated as what is the probability of winning. So let's say it's 45%. Into the average winner. When we win on average, how much we win? Let's say it's 2. Okay, so that's 45 into 2 is 90. Minus what is the probability of losing? Because the probability of winning is 45. So it means 55% probability of losing. Into -1. Say every time we lose 1 on average. So when you total this, on the winning side, we get 45 into 2, which is 90. On the losing side, we are giving up 55 into -1, that is -55. So 90 minus 55 is net 45. It's still a net positive. So when you do 100 trades, you can expect that net positive is 45, or if you do 0.45, 45 divided by 100 is the expectation. Okay. This is also, you can take another analogy when Dravid comes out to bat. If he has made on average 42, let's say in the T20, you expect that on average he will make 42. Will he make 42 in every match? Obviously no, right? Some match he'll make less, some match he'll make more. But as he plays a number of matches, we can expect he'll land up near 40. Okay. So now we are going to start building the system or the strategy. So let's look at the first strategy, right? We are going to be doing the strangles, as I said. So we are selling out of the money call input. You can visualize or think about it like a short strangle or strangle seller is trying to squeeze the ATM people, like, because if the market remains in a range, the strangle sellers will make money, right? So we are going to sell out of the money call and out of the money put. Okay. What we are going to do is we will do 2 strangles. I call this like as a double-decker strangle, 2 strangles. So first strangle will be 3 OTM away, right? Whatever is out of the money. So say in Nifty, the OTM is 50. The multiplier is 50, right? So 3 OTM will be 150 points. And 6 OTM is going to be 50 into 6, that is 300 points, right? So maybe we'll build this on Nifty and we'll see, same can be applied to Bank Nifty also, or we'll maybe use Nifty for example. So we're going to sell 2 strangles, 3 OTM away and 6 OTM away. So 150 point and 300 point. Whatever is the strike, it will automatically choose based on the ATM. Correct. And most important for a trader, a rule-based trader especially, or what is the benefit of rule-based trading, as Vignesh was saying in the start, it is the ability to cut your losses, have an exit rule, and ride a winner. When the winner is there in your favor, you run it till your target are met. But when a stop loss hits, it puts you out, which is the biggest challenge for most of us as manual discretionary traders. We sometimes don't put a stop loss. Many of us don't do that. And I think even if we do, we don't follow it consistently, right? So that is the biggest advantage of rule-based trading. It can kind of, minimize this emotional angle and the mistakes we typically tend to make because of this. All right. So how will we, the 2 more questions are there before we start building the system. What is the stop loss we are going to use? So on each leg that we sold, the call and the put, we'll say use a 25% SL and a target that we'll do. So if you're making 75% of the premium, we'll book it and get out. So just simple example, suppose we sold the option at 100. The stop loss is going to be 125. That is 25% of 100. This 25 gets added to 100 on the upper side. That is the stop loss, because the option goes up, we lose money. And the target is 75% of 100, which is 75 rupees decay. So when the 100 rupee turns into 25 rupees, if it comes, we get out. We take 75 rupees, 75% of profit and get out. Okay, so that is the entry exit. What time we'll enter? We'll enter at 9:30. We'll just wait a little bit of the opening volatility to subside. Capital approx this needs is 2 lakh, but then we'll later see how we can optimize this when we create multiple strategies. But just note for now, a strangle takes about requires lesser, actually about 1 lakh for Nifty, but we are going to use more capital. And reason is we want to keep the risk a little lower. So when we build the strategies, actually, we'll talk more about the capital. Okay, and this is completely intraday. So basically, whatever happens at the end of the day, you get out no overnight positions. So being totally intraday, one is that you can leverage the stocks as margin because it's fully intraday. So you can take maximum benefit of the stocks for margin. Okay. So now let's start building. Okay. So I'm going to use this tool called Algo Test. It's one of the tools of no code programming where you don't need to know programming. So we'll just use this. Okay, I've logged in already. And to the left, you see this button, add new. So there are a few strategies already created, but the moment I add new, it gives me a blank template. And we'll start creating the strategy. So the instrument is going to be Nifty. It's intraday. Underlying from cash or future, this is very important. If you take future, it is going to take the monthly future as a reference. But the monthly future is not a correct reference for the week because there is current weekly price, maybe something else, and the monthly future is something else. Unfortunately, there's no weekly future. Correct? So, but don't take futures, take cash. This cash is more representative of where the market currently is. It will be more closer, more correct than the monthly future. Okay. So just take underlying from cash. You get a more correct ATM or center of the market than the future. Future might give a little lopsided. Okay, and entry time, we said we're going to put it at 9:30, right? It's intraday. Leg-wise settings is also another good feature. What complete square off means is if any leg's stop loss is hit, it will square off the whole positions. Right? All the positions in that strategy will be squared off. But partial, what it will do, if any SL is hit, it will only square off that leg and leave the other leg. So each leg is independent of each other. So what we are going to do, use partial square off. Right? If one leg gets stopped out, we want the other leg to remain. And this is how it can get converted from a non-directional strategy to directional. So when, say, you have done a call and a put short, and say like a market like Tuesday and today, right, or Wednesday and today, actually, Wednesday market fell, right? So the put short would have got stopped out because as market fell, the put price would go up. But the call short would have remained, and they would have made, if he stopped out early or got out, the call short made much more money than what was lost in the put short, and net that whole position was profitable. The trade was profitable. So that's the beauty of using this partial exit, and we'll be doing that. Okay, now let's start building. So you see there is a add leg feature here. This is the ticket. We are just going to use that to create the leg and actually then add it. So I'm just going to, I can either use this button here or use. So I'll just say one lot sell call weekly, strike type is OTM3. Just add. Okay. So it now creates the leg here. You can see with this copy button and this cross has come. This is the leg created. So two things to add, very important, right? As you know, we have discussed. Stop loss is percentage 25%. And we'll add a target profit saying percentage 75%. All right. Now we create a copy of this, just copy this. So it has created the same leg copied. But now instead of call, we are going to sell put. So it's a put short, okay. Remains weekly, OTM 3, same. So whatever the ATM, it will go 3 OTM and 3 OTM, 150 points above, 150 points below. Sell the call 150 point above, sell the put 150 points below. The percentage profit and the stop loss percentage remains same. Okay. Now I'm just going to go and run this for the last year, right? So we're just going to say start backtest. Okay, run, it's done. Now you see it's created a chart where the dark blue line is the underlying, or which is the bank Nifty, the Nifty itself, and the green line is the profit of the system. But in any kind of trading, it's extremely important to not miss out the costs, correct? Because whatever we do, the costs are something we have to pay, right? Regulatory costs, brokerage, taxes, I mean, regulatory, whatever taxes are there, we have to pay that. So, and also there is slippage that happens. So, as you know, so when you go to buy, if something is showing 100 rupees, it will not come at 100. When you buy it, you have to pay a little more, right? So, and likewise, when we sell, it will sell at lesser value than where it was showing. So the slippage and regulatory costs and transaction costs and brokerage, all this totally we estimate as 1%. 1%. Okay. So effectively, if the option buy was at, or sell rather, was at 300 rupees, it will minus 1% from that, which is 3 rupees, right? So 300 ka 1% is 3. 3 will get minus, it will actually sell at 297 instead of 300. But this is a more real, this is a realistic number, and 300 is not realistic at all. So I'm just going to add one and just say recalculate. And you'll see how this profit changes, right? Profit and max drawdown also changes. So the profit will drop, okay, drawdown will increase. Yeah, but this, what you're seeing is realistic. It is something realistic, right? We'll obviously add more strategies and see. So just see this as a template to understand what are the few things that I would look for when I'm building the system. So first, I would see, obviously it's profitable. Yeah, it's 15,000. Even if we use, say, 1 lakh rupees on this, right, which is for the margin, a little bit for drawdown, 1 lakh, I make 15% on that in the 1 year. The risk or drawdown is about 14,000. So nearly 1:1 reward to risk for this system. Okay. It's still okay, 15% return. Win percentage is 62%, loss is 38. So 62% of time can expect this is going to make money. When it makes money, it makes about 690 rupees on average on one strangle. But when it loses 984. So the reward risk ratio, some of you would say, hey, this is very bad. Like, it's losing much more than it's winning. Yes, that's true. That ratio is about 0.70 risk reward. There's more risk than reward per trade. But the advantage is that because its win percentage is high, right? That is making up for the losses, and net still making. It's not making a lot of money. It's okay, but it's still positive. You'd remember that 45, 55% probability expected value thing we did. So if the win percentage goes up and the average winner to loser ratio comes down, or payoff ratio, as they call it, it's okay because they may compensate each other. If win percentage goes down, you want a higher reward to risk ratio to offset. And so these are two factors which keep moving like a lever. Okay, so I would also look at the return to max draw. It's 1.0, nearly little above 1, not great, but okay. Expectancy is 0.06. It's positive, very slight, but still positive. Max losing streak, it's lost 7 trades in a row, which is okay, but it has won 10 trades in a row. Right. So I would look at these statistics. Now, if you want to go a little longer, you can just quickly go here and change this date. Okay. So you can like make it 1 January 2000, sorry, 1 February 2019 also. It's the point from where the weekly contracts of Nifty were introduced. So you can run it for a longer period of time also and just see how it did over the whole period. Right. So you see the curve is still decent. There is a bigger drawdown here. This is during the COVID period, right? Since March 2020. But other than that, it's pretty okay, right? And if we go and add the slippage, right? So now it's made about 76,000 in 4 years with a drawdown of about 27,000. So this ratio is slightly increased. The expectancy is slightly increased. Win percent is slightly lower. Now I'm just comparing the whole 4 years versus the 1 year, but still okay, right? Okay, decent kind of return, not too high, but decent. So we're just going to save this strategy. Okay, so I'll just save this strategy. We'll call it as FYERS DD short strangle. Yes, I know I have to do the second leg of the strangle, right? But before that, we're just saving it. Now, you remember the first leg was 3 OTM. Now we will do the second strangle. So in this strategy only, we're going to add. Okay, so I've created a copy again. Just created a copy. Okay, yes. So now we're going to sell 6 OTM away. Rest all target stop loss percentage remains same. Just copy this. Okay. And it's a put, and OTM 3 has to be made OTM 6. Right. What we can do here, we can do higher quantity. So instead of 1 lot, we can do 2 lots of this, because chances of 6 OTM hitting are a little lower compared to 3, and it gives good complementary nature to the first strategy. So we'll just do 2 lots here. Okay, OTM 6 is 2 lots. Sorry, these are all one lot, and I'll just say update strategy. Okay, and just say start backtest. So now this is all the 4 legs, that is the OTM 3 and the OTM 6 are all running together. Yeah, done. Okay, so you see it's still like the drawdown during that COVID was still high. Other than that, it's okay. Now we have to go and add the slippage. Yeah, so now it's about 2 lakh of profit, right, with 50,000 of drawdown. So win percent almost remains same, return to ME, but risk reward ratio has improved a bit, expectancy has improved a bit. This is a very small example in the sense to explain this whole point, but we'll be going deeper in the next strategy when add. But you see, even if I added same strategy, just a little variation, the expectancy has increased somewhat. So always people ask which strategy is the best strategy. Actually, my knowledge, no strategy works all the time, and there's no good strategy which does not work at least some point of time. So you want to run a basket of group of strategies rather. It's like when you're creating a team, you want different players, right? You don't want to bet totally on one player. That's why you want to create different strategies. Okay, but this is good. So this is our first strategy, FYERS DD short strangle now is created. Okay, and let's move on. It's very easy now because it's no code, right? You don't have to really write any. I didn't write a single line of code till now. I've not written a single line of code till now, right? And we would go and continue with this. Right. Okay. Right. So now let's see, we are going to create another strategy, which is also a strangle, right? But we will change the way we are selecting the strikes. Now, biggest point in selling a strangle is, or a writer wants to estimate the range of the market and where to sell, right? Especially in recent time, you see the volatility is now shot up. So how do I select the strike? That's why what I'll do is I will take a concept called straddle width. So let's say the ATM is at 44,000. We'll use Bank Nifty now. Okay. And the straddle, the ATM straddle is 1,000 points. Okay. So the call and the put, the total value of the ATM straddle, the combo is quoting at 1,000 points. To this, we will add a multiplier. So we'll just say 1,000 into say 1.5. So that gives us 1,500. So the upper strike that we are going to sell, upper range, is ATM level 44,000 plus 1,500, right? So straddle width 1,000 into 1.5, 1,500 we are going to add to the ATM level. So our upper call, we have got upper range is 45,500. Chance of this hitting is lower, right? And on the lower side, simply we're going to subtract that 1,500 points. So we'll do 44,000 minus 1.5 into 1,000, which is 1,500 gone. So 42,500 is the lowest strike, right? Same way, this time the target and stop loss, we'll just change a little. We'll use 20% SL, 50% target, right? And we'll just introduce one new concept, re-entry, if the target hits. So if we are hitting a target, okay, we will re-enter the trade again on that leg. Suppose we hit the call target. The market came down, we hit the call target. We'll re-enter one more position with the same logic. And capital required about 1.5 lakh, which again don't focus much. When we build the portfolio, we'll see. And over exit this again by the end of the day. Okay. So let's go back to our tool. Okay, we come back to the tool and yeah, there you go. Now I'm going to add new again. So when I add new, a blank screen comes. We'll go a little faster now because you're familiar. So we'll choose Bank Nifty intraday, underlying from cash, entry time, we'll keep it at 9:30. Partial leg-wise exit, add leg. Okay, so yeah, add leg. Okay, so we'll sell call weekly strike type. I'm going to choose straddle width. As I choose this, it opens up this two windows. Plus, for the call, we are going to add to the ATM. So plus and 1.5 of the width, right? That is the multiplier. We're going to add this leg. Along with that, we add the stop loss. So it's percentage 25%. Okay, target is 75%. We get 75%, we are out. And we will just do another feature called re-entry on target. And this has multiple options, but just choose re-entry ASAP. And one time, ASAP is immediately. Okay? So not going to wait for any other condition. Just the moment target is hit, re-enter immediately. And how many times you want to re-enter, you can specify. So let's say I'm taking one time. Okay, now we'll create a copy of this because we have to do the put leg. So instead of call, we'll make it put. ATM strike. Now here, just be careful. Most people make mistake here. We all do, we are humans. So instead of plus, many people leave it at plus instead of choosing minus actually. So we leave it at plus. Choose minus here because in the put side, the OTM will be below the ATM, right? So ATM minus 1.5, that remains same, 1.5 into multiplier. So we all set. Only thing you have to change called put and make sure the plus becomes a minus. All right, target profit is 75%, stop loss 25%. That's all okay. Re-entry on target one time. So ASAP again, that also remains done, right? So strategy is ready. Let's test it out. So I will just say 1st February 2019 till date. Okay, so we'll just go here and say start practice. So you're just seeing that while this is running, we are using some variations in strategies. Earlier, we selected some OTM 36, which was fixed like a range. Now we are making it dynamic. We are not selecting some fixed kind of range. We are making a dynamic strikes, whatever it comes. Look at it. Okay. So again, profit curve is upward sloping, decent, but very important we have to add is a slippage. So I'll just say add 1%. Okay. This is making 1,72,000, but the drawdown is absolutely low. It's just like 4,200. So the reward risk is phenomenally good, right? Very good return to risk ratio. 64% winning, and average profit. Your interesting thing is average profit to average loss is greater than 1, decent, like 1.2. So even the win percentage is higher, like around 65%. When I say higher relative, I'm saying everything subject to 50. Say 50 is the middle line, 65% winning percentage, and RR, reward to risk, is also 1.2. So this is why the return to risk is magnified significantly in this system. Expectancy is 4.42, which is great for a single strategy. It's very good. Max losing streak is just 5 compared to winning streak of 15. So like great, this is decent. It's quite nice. I like this. And we will save this as, we'll call it FYERS short. I'll just call it width. Short width, right? So done, and this is Bank Nifty. FYERS short width Bank Nifty. Okay, so both our strategies are made. Now, one of the very useful or friendly features of this is to create new strategies from existing strategies by simply just copying. So now this same thing, let us run it on Nifty also. So I will just say save as new. Call this as FYERS short with remaining as Nifty. Okay, done. So you see out here, it will it's created a new strategy with the name FYERS short with Nifty. I have to just go up and make sure from Bank Nifty I choose Nifty. Okay. So Nifty, we'll just run it once, just see how it does. So same parameters we are using for Nifty also. If you want to experiment, you can, again, all these parameters, everything is nothing like you cannot change. This is for you to tweak, play around, and you may want to build completely of your own, something new, but this is just an approach of how to think and how to kind of build. All right, so this is Nifty. Okay, it had a steep drawdown in COVID. Other than that, it's pretty okay. Still, it was, so I have to add slippage, but returns will be low. It's not very high return compared to Bank Nifty, but return to risk is okay. Reward risk is okay. Return to max drawdown, expectancy 0.28. Okay. And many times someone may say, I'll trade only Bank Nifty and not Nifty. Why not? Because you want the diversification, right? Sometimes Nifty might work, sometimes Bank Nifty might work. That is what we'll do when we create the portfolio. So this also is something we have done. 2 strategies Nifty we have created already for the straddle width, right? With a straddle width. Now this short strangle, which we created on the 2 OTM, 3 OTM and 6 OTM, the 2 strangles. This was Nifty, right? So we will just save as new. FYERS, I'll just call it SS short strangle and BNM. I just want to know this is for Bank Nifty, okay? And double decker is the two strangles. I have to make this as Bank Nifty and update. SSB and update. Okay. All right. So now we have 4 systems. Short strangle on Nifty and Bank Nifty, right? Which was the 2 strangles, and the ATM with 1, which is just 1 strangle. But that is also on Nifty and Bank Nifty, right? So coming to the final kind of part where we eventually now are going to merge these strategies together. So let's say, what if we created a portfolio? Okay, so we just say we are going to create a portfolio, right? And we'll create a new portfolio. So we are just going to give it like, say, FYERS index option. Okay, and we will choose our strategies. So we'll choose all these strategies. So it starts with FYERS. Right? Just say create. Okay, and before going to the full backtest, now it gives us the option to change any quantities. I just want to leave everything multiplier same, nothing extra in any system right now. This backtest will start from 1st February 2019 till date, and I just have to say run portfolio. So when I'm doing this now, what it is doing is each of this system it is running, whatever we ran individually, it's running a combo. And in the bottom, it's going to give us like this percentage tracker of how much of the portfolio backtest has been done. So yeah, 25%, like so out of 4, 1 strategy got done. And this might seem a lot to you, but this is very, very fast based on the backtest. I mean, what I feel for me, because I've gone in the earlier parts, actually building this in Python, testing, should take far longer time, sometimes 30 minutes on a system. So they have optimized this pretty well, I think, and I find it pretty friendly to use. Okay, yes, so that's the combined curve of all the strategies, right? You can see obviously, so we titled this like, it's like a Brahmastra, which is basically the ultimate weapon. And that is actually combination of strategies, right? That is the very, very big edge that a trader can have. Obviously, it will require a little more capital, but the benefit again of this is it's fully intraday. So you can leverage stocks also, your portfolio of stocks, and deploy these kind of strategies. So that to in some extent the higher capital requirement can get minimized by the ability to put stocks as margin. Okay, so decent curve overall, but again during COVID was the only period where there's a drawdown. But just see the number. You see more greens, right, compared to any other single strategy. Mostly they are. That shows just in the first look they seem to be complementary. I don't know yet. I've not like run that, but it looks like, right? So definitely profit will go down after adding slippage. So it's about 10 lakh of combined profit across these. And now you see the return to max drawdown is 2. So obviously someone can again argue, hey, why don't I put all the money into this system with 10 return to max drawdown? The point really is you don't know which strategy is going to do what. It's like saying what pitch you're going to get in the cricket field, you cannot say for sure, right? So you prepare you have to have players of all kinds who can play a fast pitch, a slow pitch, medium pitch, whatever, right? Same way, you want to create a strategy called a strategy like a player. You want to have all types of strategy which can adapt to any kind of condition you get, like a pitch or market. Okay. So this is which may not be the best out of all these, but it's better than some. And when you create more and more, you can just go on maximizing this. Just focus on trying to maximize this. This is also 0.87, could be a little better, but some of the sample strategy we have shown, you can obviously, there is kind of room to create a lot more. And this is an introductory kind of idea for you to build, but you may want to add new things. And when you're doing that, see if you want to improve this. Expectancy is about 121. Still, it is positive. It's decently positive overall. And let's see the drawdown. It's about 1,20,000. So for a 10 lakh return, about 1,20,000 drawdown in obviously a 4-year period. And now to actually see how complementary the strategies are, or as we call it, how correlated they are, go to this correlation matrix, right? So what this does is, say this FYERS DD short strangle, right? The double decker, the 2 strangles, along with the short width BNF, right? The ATM width one. Their correlation is showing 0.35. What this means is that when one makes 100, the other makes 35, right? So they are, that's the extent of money this makes. When this makes 100, this makes 35. When this loses 100, this loses 35. They are positively correlated. So this one is 0.65, which is a little on the higher side, but it's still okay. When you're creating these correlations, try to take strategies between plus 0.3 to minus 0.3. So you can try to take a strategies. One is, along with positive, you want strategies also which are negatively correlated. Like when one is making money, the other is losing. That's great, and vice versa. And the extent can be, ideally try to choose more of strategies which are between plus 0.3 to minus 0.3, right? Plus 0.3 to minus 0.3 is the range. Some strategies here, there will be a little more near 0.45, 0.50, 0.60 also in this case. Okay. But most of your strategies you want to be created between this range. And as a result, your total portfolio level correlation would be near, you want to be near zero. So when you have some pluses, minuses, they'll start canceling. Near zero correlation means like absolutely like whatever happens, it doesn't affect your strategies. That's the idea. What happens to Nifty? Adani news, this news, some earthquake happens somewhere. Okay, it doesn't affect your strategy. Obviously, there's no guarantee that what has happened will exactly remain this way. So these have to be monitored and checked and tweaked and time to time upgraded. But it gives you a fairly high confidence that this is something I can try with, test out. First, do some paper trading, maybe, which is virtual trading, right? As you see here, maybe then deploy a little bit on live with one or two. But when this is worth something to try out, and then if it looks good, you get confident it's doing well, you can scale this, right? You can start adding more money. So this is a very powerful feature. And, the trades can also be downloaded. So this is basically like everything can be just, you can go here and say download report. It's going to download all the trades. And, this can also be taken live. So when you go to live trade, before that, when you go to paper trade, I'll just show you for any one strategy or something, right? It will just, just go to paper trade. You can go to any of those strategies, right? We created and just say activate. So it will run it. Right now, if I try to do it, it will not allow because it has to be only done between 8:45 in the morning to 3:30. And lastly, this same thing can be taken for live trading. So you can just click here, right? And there is a way to set up a broker. When you set up, it will list you various brokers, right? And you can then just go to, the brokers coming up, which are FYERS, be coming up soon if it's not already there. And you can just go and then just plug in your credentials and take your strategy live. So this is what covers the presentation broadly. If there are any questions for 5 minutes, we could take that. Should I just go out in the chat or the Q&A? See quite a few questions. So Dinesh is saying, is this related to long-term or short-term? Dinesh, this is all short-term, like intraday trading. I'm not sure what the context was or answering that line. Suhas is saying, yeah, the timing I'm sure is explained 9:30. Yeah, can you buy put instead of sell? I think the selling gives a more edge than buying because for the buyer, the theta decay is the most, biggest enemy of a buyer. So when you write option, see, market can give 3 outcomes, right? In direction, it can either go up, down, or sideways. When you write an option, you have the sideways direction is in your favor. So out of the 3 phases, 2 phases, including the sideways direction, let's say you sold a call. So you are basically bearish. right? So if market goes down or if market remains sideways, in both cases you'll make money, or you might lose very little if it's sideways, but you'll mostly make money. You'll only lose if market goes up. Right? So there's only one direction against short of three. So the edge in that way is more with a seller. So I prefer for buying. There are some other systems and it'll be very selective. Mostly it is all, selling. Yes. So Raghav, OTM 6 is 300 points in Nifty. 15 to 6 for Bank Nifty, it will be 600 points. 100 into 6. That's 300. Yeah. Coming to the margin between totally. So for this whole portfolio, if you do, there are basically 3 strangles of Bank Nifty and 3 strangles of Nifty. So Bank Nifty requires about 1.5 lakh margin. Nifty requires about 1 lakh. So totally about 9 lakhs of margin, and you can keep 1 lakh something for mark to market or drawdown. So this thing can be done with 10 lakh. If you want to be a little more conservative and better capitalized, you can put 11 lakh or 12 lakh also, which can be, if you're especially taking margin against stocks, you just have to put a little bit of component of that in cash. So with that, about say 10 lakh, if I consider 10 lakh return, so it's about 100% return in 4 years with a drawdown of 10-11%. Right? So the annual average return is 25%. And when you are seeing, that's the benefit of doing portfolio, because we can, use all the margins of each strategy. With the drawdown of all these don't come together because they're complementary. So you don't have to keep exactly separate margin for each. When you combine, you can use the capital better. That's the idea. Yes, the multiplier is to the ATM price, Mahesh. So Nifty 1500 point range, Pankaj saying no. So Bank Nifty, we were taking that range as example. And in Nifty also, if the ATM width multiply, say right now, if Nifty ATM, the straddle width today goes to say 600 points, for example, multiplying that into 1.5 is 900. We want to sell 900, it will automatically adjust. And it might look far or slow, but near, but that's not something we have to worry, because the volatility is more than the strikes will move far automatically. And that if you sell very close strikes in a high volatile environment, chance of getting stopped out is much more, right? Reward risk also may not be favorable. That is why that straddle with multiplier rule automatically magnifies the, gives you kind of the volatility which is being currently factored in by the market by traders. So that strike selection is very, very useful. Prashant saying, is it manual or algo trading? Is automated. Yeah. So there are quite a few more questions, but if we have time, can I take? I'm not sure if we have.
We do have a lot of questions pouring in.
Yeah.
I do have quite a few questions pouring in from YouTube as well. So let's take a few more questions before we move on to the conclusion. So Shriram on YouTube is asking us, what is the capital needed for the full portfolio? What is the return in percentage?
Yeah, so I just answered that, Shriram, right? Which can take about 10 lakh capital, 25%. If you want to be a little more conservative, take 12 lakh also, 22 to 24% annual return with a drawdown. More important than return, along with that also is the risk. So risk is about 10-12%. And that SEBI statistic where 89% people more lose money, it's largely because of the drawdown. Once your loss starts going beyond 10% in the account, most people, half the people stop. And in 15-20%, 80% people stop trading. With a 30% drawdown, hardly 5 to 7% people can continue. So it's a drawdown which is very important, and that's where you should focus on, and a reasonable return.
Thank you so much for that. Lakshman wants to know how to reduce drawdown.
Yeah, so Lakshman, believe me, any single system, it might right now show you a good low drawdown, also high return, it's good. But when you start it, can you be certain that it won't breach that old drawdown or it will not go more? At some point it will actually, right? So the best way, in my opinion, is to diversify across a basket of strategies which are complementary. So even if one goes into higher than normal drawdown, it's like when one player's Kohli's having a bad patch, maybe the other player is coming and playing at that time. That's very important.
Brilliant. Vivekji, I do have a lot more questions pouring in. We have about 62 questions in the Q&A option. So I understand we might not be able to answer all of them, but if you could maybe take about another 3-4 questions,
Sure.
ones you feel are the most appropriate ones.
Yeah. So Krishna has got a good question. Can we do with small expectancy ratio every day I run the strat? Yes. So Krishna, remember that casino edge example. Just remember that for the roulette. The edge is 1/37. If you take it in percentage, is around 2.7% edge. But they have one is many roulette tables and they have many other games, right? So there's a blackjack table, there is some slot machine, there is a lot of other games. And there are small edges on all the games. When you combine all those, the edges go up. Same if you saw in our systems when we were building, somewhere we had an expectancy or edge of 0.06, 0.10, 0.15. But when we combine one or two good strategies, maybe 0.4, 0.5, which you don't know, which some will do very good also. When you have a good basket, you have the odds of some strategy. So the edge can be magnified by combining strategy. Again, that's one of the way I know. Probably it's a way tested and tried way, and it's been working for years. And I know a lot of hedge fund managers, traders use that approach to survive. Okay, so Kendu is asking a good question. This algo is only for underlying levels. Is there option to use indicators? So Kendu, I'm waiting that myself. So the indicator-based tools are coming up because there's a lot of demand from users. Like I'm a user, just like you, we are all users, and I'm hearing that it might come soon, right? Okay, so Kanakraj says technical glitch of fitting SL. Do we have a solution? Algo will take care. Yeah, see, let's understand this trading technology is a very, very, very complex thing, right? There's a lot of complexity in the trading system. The New York Stock Exchange trading system is the most complex system on the planet. Now, what it means, glitch cannot be avoided. It can only be minimized. So again, here's where I think take it as part of the game, right? Always don't leave it totally unmanned for long. Like I have a watch on the algos and MTF. Don't blame the broker, exchange, even something goes wrong. See, I've been on the broking technology side for years. I can tell you there is nothing more complex, and sometimes something which you totally never thought of will go wrong. You just can't help it, right? You have a primary line, a backup line, both lines go down. It has happened. So all you can do is minimize. You can try to minimize and be more watchful and just be alert, right? But far better than the years earlier, right? And look at the load also. There's so many people trading, right? So I'm sure the infra is improving along with time. Okay, so yeah, this humanly executing is very difficult, Naveen. Nearly impossible, in my opinion, after a point, because some people probably do that basket file upload and still do. For 1-2 strategies, you may do it. But like I run 25 strategies to give you an example in the live, right? And I do sometimes 100 orders in a day. And sometimes there are 4-5 orders in 1 second. It's virtually impossible. 2 is the discipline factor, I think, comes via system, right? So when it's automated, the chance of that human trader also dealer sitting on that desk and his or her judgment coming in, overriding can get minimized by all. So algos have been working for me, and I would say definitely. Yeah, so there are a lot more. Unfortunately, I think we won't be able to even answer all, but I'm happy to, be reached out on and answer them gradually. So,
Vivek, why don't you share your screen where you have your coordinates that they can write to you?
Yeah, sure. So, yeah. Oh, this is the slide where I was talking about how the blend of strategies.
Please initiate the share screen once again.
Oh, sorry. Okay. So just go here and share screen. Yeah. Can you see this screen?
Yes, we can see you.
Okay. So this is just talking about 2 traders, A and B, where one makes the others losing. And when you, it's a hypothetical example, but you see the blend of the strategies, their standard deviation is 0. So it's just to explain the point, you create this team. You can combine all these kind of strategies with your ETF, lump sum, Bs, and whatever you do. You can also use, some people asking about long option strategies. Please understand, I do long options also, but short options has more edge in a systematic way, I think, in the longer term. And you can convert technical trading systems into long options. I'm nothing against it, but I do more of short options now. Yeah, so I can be reached on these coordinates. This is my Twitter handle at Techno. This is my email. I'll be happy to answer your questions. And
Brilliant. Thank you so much. I believe we've addressed most of the queries that have come in. Viewers, you have the contact details of Vivek ji on screen. So Technovesta, I believe, is your Twitter handle.
that's a Twitter. Yeah.
Lovely. So everyone attending here today, please make a note of Vivek ji's Twitter handle, and you can reach out to him directly on Twitter or even via email. So I'm just going to leave that here for a moment so people can take a screenshot. Okay. Lovely viewers. Thank you so much for attending this webinar. So before we finish, anything else that you want to share with us, Vivek ji, before we conclude the webinar?
No, I think it's overwhelming, the response. I'm just so glad to see the lovely quality of audience. And thank you so much, Team FYERS. You're doing a fantastic job, I think, with growing the API ecosystem for retail. I've been seeing this space for a few years, and not just because you invited me here on this webinar, genuinely you all are doing a phenomenal job. So thanks to.
Thank you so much. Thank you so much. We definitely, we will like to partner with you more and more such webinars, share more knowledge with our partners, with our clients, which, we definitely will look forward to associating with you more in the future as well.
Sure, happy to do that.
Lovely. So viewers, have you experienced the FYERS 2.0 app already? Please do experience faster order placements using the FYERS app 2.0. Not just that, the app is a lot more than just order placement. You get features like unlimited watch lists, GTT orders, watch list related news, SWOT analysis, and so on. Experience the all-new FYERS trading app 2.0. You can go to the URL fyers.in/invite, INVITE. Right now, the the app is on a limited release basis. So people will have to get on board, and there is a wait list at the moment. We will be releasing the app for everyone very soon, but please do join the wait list and experience the app for yourself. So thank you very much for joining us today. We have another exciting webinar coming up very soon in the next few weeks. So please subscribe to our YouTube channel as well as our social media to get notified about all our upcoming webinars. Thank you so much, Vivek ji, for this wonderful session today. Thank you, viewers, for joining us today. We will see you soon.